Hey, everyone, and welcome back to the Always On Point podcast here with Kristen Ambos. Sponsored and thank you to my parent company, Point Mortgage. We want to get the most accurate, up to date mortgage information to you on a consistent, regular basis. So today we're going to break up today's podcast into two parts, one this week and one next week, because together it all comes. But I want to start by breaking down what's all going on in the news cycles right now. And in the housing specific industry with the administration, jobs reports, Federal Reserve chair, what should we look for? What are things that we can anticipate? And then I also want to break down to you what it looks like in the mortgage world and what are some things that are happening in our market today that could help you as both a buyer and a seller. So first things first, we are feeling some rate fluctuations. The Federal Reserve did not move rates last week. We didn't expect Powell to, and he didn't. So here we are. We're still in the same space we were. So rates were really relatively left unchanged there. Probably went a little negative for a moment. The other thing that is really a hot topic right now that is in our industry, but I'm not really hearing it on the mainstream media, is the jobs report that came in pretty negatively. And some of the housing data and the housing reports, new application starts, are really withheld right now because of the weather over the United States in the last 2 weeks. I mean, South Carolina, I think, got more snow than Wisconsin. I know the Washington, D.C., Maryland area got hit with like a foot of snow and then 4 inches of ice on top of it. So they were out of school for almost a week, maybe even a little longer. It's just a lot of weather happening in Texas and all over the place where snow typically isn't. So for those areas on a national level, there was a lot of shutdowns, a lot of people stuck at home, not really working, or out there looking for new jobs. So the jobs report wasn't that great. So when rates opened up this week, they were a little bit on the negative side. Still locking some in the high fives, but majority of applicants are somewhere in the low to mid sixes again. Remember, I think we're going to bounce around for a while till this all gets straightened out. Where it's going to get straightened out, where I think things change, is in the change of the Federal Reserve chair. There is no doubt that the current president and the federal chair are not seeing eye to eye on things. And we did get an additional rate drop last year, which was great. And it was a little bit unexpected, helped a ton. But if you really look at the data and where things are at, the Fed, meaning they, don't necessarily want wage growth because they're still trying to get inflation to 2%. And so there's a little bit of that, that conundrum, right? Where we need wage growth, we want wage growth, but at the same time, we're also dealing with inflation. And the markets have been wages over inflation. So you've got that a little bit going head to head. So there's some resistance there. The other part of it is because of that and the difference in the administration's thoughts. And now I'm breaking it down, trying to, as best I can, layman's terms. Some of you who are listening understand it at a far deeper level, which is great. Some of you are barely trying to, keep up with me now. So we're just trying to bring it to you as simply as we can. We all know that housing has been on the current administration's hot topics since last year, and it's still going to continue to be. So we are as close as we have been to the affordability levels of 2019, since 2019. So that part is great. The rates are actually still at some of the lowest levels they've been in 3 years. So even though rates are ticked up a little bit, they're still at some of the lowest levels they've been in 3 years. But what's happening is those lower rates are not moving the housing needle as much as anticipated. So now the conversation is, how do we get more people in the industry to buy? Well, there's two things. I read an awesome article by CNBC, which really showed that there's two ways to get the affordability exactly how it was in 2019, which is either raising wages by an average of $50,000 a household. That's a lot in a year's time. And that's a lot to put on employers to say, okay, our way out of this is to increase wages by $50,000 for a household. Or they can reduce interest rates back to around 3%. Well, one of those things has a far better chance of happening than the other, which is lowering interest rates. Now, we're talking about bringing in a new federal chair, and on paper, he has been known to be dovish and not where Trump wants to lead rates go. And I'm trying not to be political about this, but just give you the data. So on paper, of course, one side of media is going to tell you this is exactly opposite of what Trump wants. This is where it's been, which is completely true. On the other side of that, he has been a colleague of Trump's since back at the school Wharton. So we're talking a really long time. And of course, whoever the new chair is going to be is somebody who's going to be in alignment with the way the current administration wants to see housing. Therefore, you can pretty much bet that he's going to do what the administration is looking for, and that's lower rates. That's something Powell has not done. Even with or without the power of the Federal Reserve behind him, it's just not something that's happening or happening fast enough to the administration's liking. So, are we going to see lower rates, over inflation, over higher wages? That's what's still left to be told. I don't feel comfortable at this time saying, I know for a fact rates are coming down, although I'm leaning more and more toward it as things happen. And now the new federal chair, I believe, is supposed to come out somewhere in the May area. So we're a few months out yet. It'll be interesting to see what happens. But just for those of you out there, I'm going to stand by what I've always stood by. Buy a home when you're ready. Refinance the house if you can get a lower rate. If you are waiting on any certain market or rate, don't wait. Because if rates come back down to around 3, and I'll be the first one to say that in the last 6 months, I didn't see it happening. I thought 5.5 would be a great place to be. I still think it will be. However, will it be enough to really, truly move the needle? We won't know until we get there. So I don't know, and I'm not saying that I think rates are coming down to 3%, but I do know that in order to move it, we need lower interest rates. Some people are out there touting the fact that we need more construction starts. And well, I don't know that that's a horrible thought process. What I do know is builders build to make money, right? They're not building on charity cases. They're building as a for-profit organization. So if the demand was out there for more new home builds, they would be building them. They would be building them, and banks would be lending them the money to build them because they could prove on their data sheets how many houses they need in order to accommodate the demand. So if builders are pulling back from building, it's because the demand isn't necessarily there. Is it because the homes have gotten so expensive that they're not affordable? Possibly. What's a way around that? Lower interest rates. If we're not going to get an average of $50,000 more in a household a year, what's another way to do it? And so all signs to me just keep coming back and blinking, billboard blinking on lower rates being the option. Now, I'm a firm believer that developing costs should be lowered, maybe a little less red tape there. But remember, every time you get rid of some red tape, there's more issues that come with it. Perfect example. The administration wants to put a maximum credit interest rate at 10%. I am all for that. I think that would be amazing. The silent pieces behind that many aren't talking about is if you don't think those credit card companies are going to come back and start charging you annual fees that they don't charge now, higher late fees for paying past the due dates, or cutting your credit limits in half, that's what's going to happen. They're going to protect their bottom line. And if they're going to take away income being made, because remember, all of these companies are for profit. Now, if they're ripping you off or not is an entirely different topic and story to talk about. But at this time, those are the things that are on the table. So we can only work with what we know and what the options are there for making life more affordable overall. I wanted to get into all of that because I think it really matters. I think it matters from what you're hearing out in the mainstream media, which I think we've all now known that you can't really take anything they say too seriously because there's always going to be a spin. There's going to be a level of spin of how does it meet their narrative. I just read the news. I just try to cut through it on housing and housing in general to where can I see my clients benefiting to be into housing more often. The other thing I'm seeing a ton of right now is buyers coming in and saying it's not necessarily the interest rate they're looking at. How do I still get a house for $1,800 to $1,900 a month because that's what my rent is and I feel comfortable there, so I don't want to go over that payment. They're leaning more on this is what I need my payment to be. Can you make that happen? And I'm all for that because if you've heard my last podcasts, monthly payments are what you need both in your home economically month over month and definitely as far as your mental needs, right? Because you have to emotionally be okay with that payment, feel confident in that payment so that you can live life the rest of how you want to live. And going into a home that's more expensive than you feel comfortable in will be difficult. And believe me when I say I've talked to a lot of clients in the last few weeks in general that have called me to say, when I bought this house, XYZ was left off of the form and I had to put a new roof on. I had to put a new furnace in. I had the water heater blew up right away. This happened, this happened. Some major mechanicals of houses have went awry. Now, I don't think all of those sellers just left that off a conditional report because they didn't feel like adding it. I feel like sometimes when you buy a home, the luck of the draw is that, especially if you bought it without an inspection, that you're going to deal with some of that. You cannot always take people's word for it because there may be underlying facts that were in there that they just didn't know about. There's going to be a seller that maybe worked a buyer over on it, and that's unfortunate, but it's happened. And what I know about this market or about the housing industry in general is it can be extremely litigious. So I just want you guys to be careful. Sellers, if you can protect yourself, get a pre-home inspection. I've talked to so many agents that are they're bringing this to their sellers to protect them from themselves, if you will. They don't know what they don't know. And this is different. Sellers, do a pre-inspection. Get rid of everything you can and fix it up. A buyer is going to be more apt to pay you full price when they see your home and they know that you did an advantageous pre-inspection that they don't have to worry about and you fix the things that needed to be fixed if there was anything. Sellers, also be careful of overpricing your house. I was talking to an agent today. 2 very identical houses within a couple block span, 2 different price points. One house is a little bit nicer, but on paper, same square footage, same bedrooms, same bathrooms. How do you go about selling that home for the value it's at? Well, you could do a couple things as a seller. You can offer a seller credit to help pay closing costs and prepaids. You could give them a seller credit to buy their interest rate down, something that's going to make that home more affordable for the buyer. Buyers are looking for more affordability. Sellers are looking at maximizing their bottom line. How do you do that? You work with a listing agent and a buyer's agent who are extremely good at negotiating, who understand what they're doing so that all sides win. Those are the deals I see winning right now a ton. When the seller understands and wants to also be there to help the buyer work for a benefit to the buyer, buyers are then going to work with the seller for the benefit to the seller. Both parties win. Now, I want you all to be very careful because there's a couple things that are new in the market that haven't been around in a minute, and seller credits, otherwise known as concessions, are one of them. I see them happening quite often. Sorry, your girl didn't even shut her own ringer off, so that was me. But I've seen sellers now negotiate different things to the buyer. Seller credits are one of them. One of the things I see happening so often right now, you've got a lot of lenders that just came into the market in the last probably 5 to 10 years. Some of them have never worked in a really difficult market. Now, the last 3 years were difficult. Don't get me wrong. They had nothing, in my opinion, on the housing crash of 2008 and 10. So getting creative of how to make sure everyone wins is one of them. Also, knowing their guidelines. The one guideline that loan officers are getting wrong left and right now is how much a seller can truly credit a buyer. It is all over the board. I'm going to tell you right now, VA seller credit is different than FHA is different than conventional. Conventional is different if you put less than 10% down, between 10 and 20% down, if you're buying a primary house versus an investment property. Most loan officers are going to tell you it's a straight 3% conventional, 6% government loan. That's not the case. It's not the case at all. And I've worked out so many of these opportunities on deals I am not even originating with the agents, because agents know this more than loan officers do. So hear me when I say you're going to work with an agent. When you have a seller credit coming, make sure your loan officer and your agent are working together to negotiate it correctly. I just heard of one where the buyer should have gotten closer to a $10,000 credit, but the loan officer misguided them and they only got $3,500. The buyer was definitely left a lot of money on the table, and the seller was willing to pay them the $10,000 he needed towards closing costs and prepaids. It's a lot of money left on the table. Seller wins in that point. The loan officer did not do their due diligence for their buyer. And that's part of why we're supposed to do this. When we get licensed, we basically, it's a little extreme, if you will, and probably a little exaggerated, but we take an oath, right? Not really, but we should, to make sure we're looking out to the betterment of our buyers, to understand exactly what is needed for our buyers. And seller credits, I'm telling you right now, are one of them. Over 50% of my files right now have a seller credit on them. Here is the other thing. Seller credits cannot be used in lieu of anything. For example, sellers cannot give you a $4,000 allowance for appliances. They cannot give you a $10,000 allowance for flooring. They cannot give you an $8,000 allowance toward a new roof, because that's all they're willing to pay for. It cannot be in lieu of anything. You cannot be incentivized as a buyer to buy the home outside of the basic closing costs and prepaids. Now, one of the closing costs you can do, though, is buy an interest rate down via discount points. So let's say the seller's going to give you a $10,000 credit. Your closing costs and prepaids come to a total of $8,000. You could take that $2,000 and buy your interest rate down, and the seller can absolutely give you that full $10,000 credit. Happens all the time. You can do that. Now, if your loan officer doesn't know that, you might be sitting on a higher interest rate and gave up $2,000 back to the seller because they didn't think you could use it. As a buyer, that would really burn me if my loan officer wasn't aware of how they were supposed to be working for me. Just a few things to take, into full consideration on, because you don't want to leave anything on the table. Did an example today of a purchase price, $470,000. Buyer was putting 10% down, not 10,000, 10% down. $470,000, loan amount of $423,000. That seller could give right around $14,000 as a seller credit. It was a higher price point. Taxes are higher. Insurance is a little more expensive, plus your closing costs. So you're setting up your escrow account, your 1 year of homeowner's insurance, getting all that interest, that prepaid interest in there. So total costs to close for that buyer were that $8,000 that I just gave you an example of. But the seller was willing to give $14,000. We bought their rate down a total of 0.5% of interest rate. For that $14,000 credit, the buyer would be saving at a minimum $48,000 of interest plus $135 a month in that. Of that $48,000, they were going to feel $135 per month in a reduced payment. That's one way where both a buyer and a seller wins. So those are things that don't be afraid to ask your lender and your realtor to work together on, to make sure they are negotiating you the best deal possible working with those finances. And don't be afraid to call your lender to sit down with them and talk about how you can make that work. I did that this weekend with some clients, which was awesome. They want to know, is it better to sell? Is it better to fix up their house so they can capitalize on more, selling it for more? Or is it better to keep the house as a rental and move on? A lot of really good options. They have all those options. Let's talk out which one is best for them. Is selling it As is better than putting a little bit of money in to gain more. Depends on what needs to be done. That's where your agent comes in. Your agent can help tell you what you're going to get your best bang for your buck on by putting money into the house to sell it and get more. Where a buyer is actually going to look at it and go, I want your house. I'm willing to pay you more because it's got a lot more to it than the house down the street. Buyer and seller win. Or maybe your house doesn't have all that much and it doesn't make sense to put a lot of money into it, so you're selling it as is. The buyer's willing to come in and put their own money into it, but again, you're going to offer them a pre-sale inspection or maybe even a closing cost credit to help them keep money in their pocket so that they can put that money into the home for when they live there versus you, the seller, doing it. See what I'm saying? It's all coming back around. Don't stay so fixated on where rates are at, because I can tell you, if you buy right now at a higher interest rate and you qualify to refinance in a year or 2 years when rates come down, your value is going to go up and your payment's going to go down. You are going to be sitting in the best of all worlds, the way the buyers did back in 2018 and 19 that bought, with a little bit of a higher interest rate and then refinanced when rates come down. That will happen again. So if rates do come down under 5, go to 4, or potentially even 3. And the reason why I will never say that they will never go down to 3 again is because they've done it before. So if they've come down before, it's possible. And if it's possible then, it's possible now. We'll see what happens. We'll keep bringing that information on the podcast. That's where you want to subscribe to the channel so you can hear every week. We will bring you that information. But for right now, that's where it stands. I'm still going to sit here and you can listen to me, or if you're watching on YouTube, visually see me say, buy when it's the right time to buy. You're always going to win at that point. Instead of waiting, don't play the market, because right now the market is extremely volatile. And every week, every month, I'm going to come to you and it's going to progressively be different than what I'm saying today. Welcome to the housing world. It's so crazy. I keep saying to people too, everyone keeps saying, Kristen, when are we going to see a normal housing market again? And my answer is, I've been looking for that for the last 24 years. So every year it's different. I'm going to hold true to that, because what is normal? What is a normal price on a house right now? I'd love for you to ask your real estate agents, because they can't answer it either, because everything is so different. So asking them what a normal house price should be, or asking your loan officer what a normal interest rate should be, is really hard to do right now. So be specific, work with somebody you trust, just definitely get it all in there. But the main topic for today was to come in and really explain to you why the market's volatile, why we're going to see rates go up and down and up and down. We're going to continue to see them up and down. We're going to continue to bring that to you. But don't be surprised if one day it's at 6 1/8 and the next day it's at 5.875. Work with a lender. Here's another key note. Your lender should be able to renegotiate your rate down in process if it falls 0.25% or more. So keep an eye on that, because you want to make sure that if your rate can fall 0.25% or more and you can achieve that lower rate while you're locked in, you want to take advantage of that. There's so many loan officers I talk to are like, oh, I don't offer that. I don't feel like redoing the paperwork. Well, I feel like saving you a lot of money. So if I can get you 0.25% lower interest rate and renegotiate it down for you, I'm going to do it no matter how much paperwork there is. So make sure you talk with your loan officers on credits. Make sure you talk with your loan officer on interest rate and what they're willing to do, if anything, should rates fall. And make sure you're locking in when you feel comfortable to lock in, because if that loan officer is floating your rate right now without your permission, they are playing the market. And that's just a really, I'm not going to say it's not a great place to be in right now, but if you're willing to play the market, then you're typically willing to sit down and be a high bettor at a blackjack table. So you know the rules that come with playing the market. If you are not a gambler and you don't enjoy playing the odds, don't float your interest rate. Lock it in when it's comfortable, get that payment when it's comfortable, and you will win every single time. So hopefully you found some good nuggets in that. We're going to come back next week with the second half of that of my most asked questions right now. So stay tuned in next week, where I'm going to come back and I'm going to answer those questions for you so that you continue to be educated for when you're either ready to buy again, ready to buy for the first time, or be prepared to refinance when things are normal again, right? Normal again, meaning lower rates. Hope you have a great day. Thank you for listening. We'll see you next week.